Let's look at the stocks. The Dow is down 200 points.
Joining us now to discuss this is financial expert Terry Savage. A lot to get to. Is the biggest impact for the average American who does not invest in these two banks? Will it be at their bank they should worry about, or is it mostly about the stock market?
No, let's start with that. Your money in the bank, I think most of our audience does not keep more than $250,000 in a bank. It was always safe, always insured. They made an exception this time because they were worried about these two banks, the Silicon Valley Bank and Signature Bank, because the vast majority of their deposits were over $250,000, because that's where the smart money banked out in tech land, and they would put venture capital money in there. They'd invest in these companies, and they'd say to the companies, leave your money in there and then make your payrolls through there. So when they had the problem, which I'm going to describe, all of a sudden there was a great fear that this would really totally shut down the system. So what the Fed did over the weekend was say, for these two banks, and implied that for others, that anything over $250,000 would be taken care of by the FDIC fund, which will levy fines on the banks or fees on the banks, and by the Fed, which will open its windows so that this will not spread. I think it bears explaining what happened. When we think about bank failures, we think they invested in bad stuff. Remember the savings and loans in the late 80s? They invested in ski resorts and stuff like that. How about the mortgage crisis of 2008? They made loans to people who really didn't even practically exist. This time, this bank invested in U.S. government treasury bonds. And they knew that they could get higher interest rates on longer-term bonds, so they had like 10-year bonds. Well, they were fine. Remember how we all were worried that we lost money in both stocks and bonds? We learned that when interest rates go up, the market value of your bonds goes down. I mean, if you hold them to maturity, they'll get paid off. But when rates go up, who wants your old 2% bond with cash? They could buy a 4% bond. So in the market, the price goes down. And when they started facing withdrawals, they had to sell some of those bonds at a loss, and it became apparent that they were eating into their capital.
But Terry, when COVID was here, the government was pouring money into the system. We were talking about how inflation's coming. So if we could see it, why couldn't they see it? Was this a failure of the government regulators?
No, this wasn't a failure of the government regulators, except for the fact they might have looked at this bank and said, you've got some short-term deposits here, but you've got long-term bonds, and you might have to sell those at a loss. That wouldn't have happened if the Fed hadn't been raising interest rates so sharply, which brings us to the current question. Your money is safe. They've decided to make it safe, even over $250,000 there, so likely anywhere. But the real question is, what does this do to the Fed? It was about to raise interest rates again because they're fighting inflation. Can they raise interest rates again, knowing this impact on the banks? The Fed is no longer all powerful here, so this raises questions. The other thing it is, all the other banks. Remember, we've been telling you to take your money out of the banks. I've been telling you to buy treasury bills at 5.1%. Over the weekend, everybody took money out of the banks, and the yield on treasury bills today will be about 4.7%, a rush to safety. So now the banks will have to raise their deposit rates to attract depositors who are a little shaken, but higher rates, and it's insured. So that will cut into their profit margins. So you see bank stocks going down because they won't have such big profits anymore. We're not dummies. We don't leave the money there. And that's impacted the stock market. But overall, I just can't stress this enough. It's not political. It's not what the president said. The FDIC, the Fed, and the Treasury have decided that they are going to bail out the depositors, and I want to use that word, over 250,000 insured level at those two banks. And that should stop this right now, this confidence issue.
So the average person, even if it's under 250,000, you shouldn't worry about the FDIC if they're protecting everyone. Are they going to run out of money to protect me in the long term? It's still safe.
It has always been safe. It's still safe, and that's the real issue, by the way. They never run out of money. They can always create the money. It's the U.S. government behind this, and that's inflationary. So that's what's the real issue. Do you worry about inflation now?
All right, Terry, thanks for joining us. If you have a question for Terry, she will answer them at terrysavage.com. Have a good day.
Thank you.
Let's take a look at some of the stories.